Hey founders, welcome back to another episode of the Gab Lab. This is the show that's designed to bring you financial intelligence that won't only just blow your mind, it's really there to help you build your bottom line as well. I'm your show host, Tanya Woods Richardson, and our episode champion today are very good friends over at Community Future Sunrise. They are a team in Southeast Saskatchewan that are helping founders not only build their business, but helping them to nail their numbers too. Now, speaking of numbers, that's what this episode is all about today. We are getting into the nitty-gritty of equity financing. And our Nail the Number Pro today is none other. We've got the best for you, Laurie Dmytryshyn. She is the Chief of Equity Investment at PIC Investment Group. So with that being said, you do not want to miss this episode. Please go grab a coffee and I will see you in the lab. Well, hello and welcome to the Gab Lab, Laurie.
Hello, how are you today?
I'm doing well. I'm doing well.
Good.
Spring is in the air. Happy to be here. So happy that you're here. Really excited to actually dig into the topic of equity financing. I know for some founders out there, that term can seem a little overwhelming and they don't know where to start and they think it's just for big business or for innovative businesses, tech-based businesses. So really happy that you're here to shed some light on the topic.
Well, thank you for having me. I'm thrilled to be here.
So, I'm curious. We're coming off a weekend. I actually read an article in I'm not going to say in the paper. I read an article online the other day that was talking a little bit about accessing capital. And this was a specific startup that had come from I guess an appointment with a banker. And it dawned on me as she was expressing her discontent with the process of being able to access debt financing. And I know we're talking all about equity financing, but it was interesting because I feel like we are living in an ecosystem right now that it's almost the expectation that people are able to access funding. It's almost like this sense of entitlement that, banks are supposed to lend and credit cards are supposed to give. And, we're supposed to get more access to money over and over. And I'm curious when we're talking about equity financing, and I know we're going to talk a little bit about what it is in a moment, but as an equity financier, do you find that there's an expectation out there of founders that it's easy to tap into or no?
Honestly, I think it depends on the stage that the entrepreneur is in, the stage of their business. I think there's a lot of capital out there right now, thanks to some recent big wins from, in the tech sector, like you've talked about, right? Like Verifin, I think sold to NASDAQ for, $2.7 billion. So there's this big glamorous sort of haze around equity financing right now. But what we do seem to hear is that, as I said, it really depends on what stage the entrepreneur is at. I think if you've got good EBITDA, good growth potential, I think, it should be not easy, but it should be a lot easier to find equity financing than it would be for an early stage startup with, just getting going, trying to convince investors to invest in their company. I think it's a little bit harder at the earlier stage, spot versus someone who has an established business, has a good track record, has solid EBITDA. So again, it's different depending on where you're at.
So we'll circle back to EBITDA in just a moment, because I know there's probably a ton of founders out there that are wondering what the heck is EBITDA, but before we get into that, let's just clarify exactly what equity financing is for the founders listening in. How do you define equity specifically?
So basically, I define equity as equity financing is the process of raising capital through selling shares. It's kind of as simple as that. So you've got debt, which you're borrowing money. You have equity where you're actually selling a piece of your business to raise money.
So you bring up a good point there with respect to maybe some of the people listening in are sole proprietorships, and sole proprietorships do not have shares, Whereas incorporated businesses, this is where we start to get into share structures.
Exactly.
So you're saying that equity is where you are selling a share in exchange for money coming in. So the only ones that can really access equity financing are businesses who have set up an incorporated company.
Yes, I guess I would have to say yes, but you'd have to talk to your accountant and lawyer and not talk to me on that, because I'm not sure with the sole proprietorship. I'm sure there's some way you can do it, but where we tend to play is definitely, with respect to incorporated companies or limited partnerships where you're dealing with units. Again, we're dealing with sort of, companies that have good growth potential too as well. That's kind of what gets us interested.
Okay. So where do you access equity financing? Who is an equity financier? Where would people go? What does that look like? I know there's different types of equity financing, so maybe laying the landscape for us.
Okay. So basically how it works is, just to be brief, I guess, but normally what companies will do is they'll start with love money. So that is family and friends. Usually if they have an idea, they want to get this business going, usually they'll see they'll go to family and friends to raise financing. There's also a group of accredited investors, and I'll get into the definition of accredited investors a little bit later, but there's a group of investors called angel investors. And what angel investors are is they're high net worth accredited investors. So they basically have certain criteria, such as, I think, again, I'm probably going to get this wrong. You'll have to check with the Securities Commission, but I think their salaries are, I think, 300,000 and more, and they have significant assets too as well. So there's sort of a system whereby if you're going to invest in a company, there's sort of a couple ways you can do that. It's through getting an exemption through the Securities Commission by declaring that you're a friend or a family. So anyone can invest as long as they're a friend or a family of the entrepreneur. But then there's also the other group where you have angel investors, you have venture capitalists, you have private equity too as well. And they usually pretty much most of the time, they will fall under that, under the sort of accredited investor definition too.
And so if we're looking at a time frame of where people would turn, where founders would turn and who they would turn to, what I'm hearing is they would first turn to friends and family.
That's usually the,
and
I guess I should have talked about debt in there too, but you're going to probably try your banker. The hardest part usually with an early stage company is it's tough because you have no track record. You probably don't have much for assets in the company. So it's a little bit harder to get that loan. We do tell people when they're in the early stage to make sure that you also are paying attention to the different government programs out there to help, because there's lots of government support programs out there that can help you, such as IRAP. There's loans-based government programs there, community futures, there's just a whole support network. So it, as I said, it starts with sort of the love money, friends and family, then usually you might be able to get a little bit of a loan. And then you often, there's a group of these angel investors where we would fall ourselves under a different definition in that we're more of a super angel. We're actually a family office. So there's also family offices out there where people are investing their own money into businesses. Then you also have the potential venture capital groups. And the difference between venture capital and an angel investor is that venture capital uses other people's money. So what they'll do is they'll raise funds. So they may have, you've got Westcap, PFM, you've got a couple others here in Saskatchewan, where they've raised funds and then they go out and invest in companies. Versus an angel investor is someone like my boss who is basically using his own funds to invest in a company.
Okay. And so so going back to the beginning, and I know you've talked a little bit about debt, so I'm going to introduce it here for everybody that's watching. So debt, as you mentioned, is where you are, you're accessing a loan that typically you need to repay, and in that process of making those principal payments, they're called, right, they're attaching interest on it.
Yes.
And you know, when I think about how many founders start out, you're right. I think it seems like first everybody drains their savings, then they drain their RRSPs, then they start using some credit card money, then they go to the love money. And that I didn't know that friends and family needed to get an exemption. Ideally, I'm wondering how many actually.
Well, it depends, you know, again, it's, you know, we're talking about incorporated companies too.
Right.
So, you know, so I mean, that's usually your lawyer. Yeah. Whenever you're like, if you're raising funds and you have a share structure, you know, normally the lawyers would make sure that all that paperwork is done correctly. So,
okay. There's a good
you'll be signing lots of things. So as I said, always make sure you have a good lawyer and a good accountant when you're starting out.
Okay, I want to come back to a question on the lawyer here in a second, but okay, so then we've got the love money. And so where you're making the distinction is that the loans they're attached to interest and principal repayments.
And you have to repay.
And you have to repay. The equity, and I know we're going to talk a little bit about this when you need to get out, because I think that, or what you need to know out of the equity financing, because I think a lot of founders look at equity sometimes potentially as free money, because they don't necessarily in their head, they can't wrap their head around, well, I don't really have to repay this. This is just money in, and they're getting a share in exchange for the money they're putting in. And I know there's that's definitely not how this works. So don't get too excited yet. You still have to get the equity founder out. And so then just to clarify, so let's say, you know, we're in business for a couple of years, and let's say our, you know, our revenues are, I don't know, I'm going to throw out maybe 250, 500,000. There's definitely some growth potential happening now. You've probably the founders have had access to a couple of loans, those early startup loans. And like you said, some of the government programs or NGO programs out there, like the Futurepreneurs, the Community Futures, one of our sponsors. And they've been able to access that and have been doing a really good job at getting that money repaid. And now there's an opportunity to grow. Maybe it's expanding outside of the province. Maybe it's introducing a new product or service. And so now they're starting to entertain the idea of equity financing. And so now you've mentioned angels or super angels, as you've talked about in your organization, as you are. When we talk about high net worth individuals, would you recommend a founder look to find their local angel network first? Or would you suggest that potentially they start, you know, making introductions to, if they know high net worth individuals? What's the right approach in that next stage, looking for that equity piece?
Right. I think, you know, if you're wanting to learn more about it, you know, there's definitely a lot of different angel groups across Canada. You know, I used to be part of a group called the Saskatchewan Capital Network, which was a group of angel investors here in the province. And what's happened is Valhalla Angels has basically SCN folded into Valhalla Angels. So there is an angel group here in Saskatchewan that's functioning. So I would, you know, recommend that someone does contact Evelyn Serta, is the executive director of the Saskatchewan chapter. And, you know, I definitely recommend that they start, you know, talking to the angel groups. You know, I think it's critical that you get an investor that can add value to your business. So it's not just money that investors provide. Investors provide access to their networks. They provide mentorship. Often angel investors are successful business people, you know, men or women who have, you know, been there, done that. You know, we always say that you always sort of really need to be careful, because it's not just money, as you said, it's a relationship. And angels look at entrepreneurs, and the reason we invest is that we want to see the company grow, and we'll usually do anything we can. We might take a board seat. You know, we might have control over certain decisions, but we just want to be there, help the company grow, but we do want to get out too as well. So we do want to, make money on our investment too. So one of the most critical things is that entrepreneurs need to make sure that they have the right investors and that they have people that really understand their industry, or they feel that they can add value in some other way. I think that's absolutely critical, because investors are putting their money in, but they do expect to get a return on the back end too as well. And often what we, when we go in, we look at probably 5 to 7 years, we would like to have an exit. So that's right off the bat in the beginning. That's something that we will talk to the entrepreneur about, and we just have to make sure that we're aligned. Because if we're investing in an entrepreneur and that entrepreneur just wants to, take our money, do whatever they want, grow their own business and then just have us stay there forever, that doesn't make sense. We need to get a return, with respect to our investment too as well. So we always want to make it clear that, we do want to know what the entrepreneur's exit strategy is. And that way then we can ascertain whether or not it's a good investment opportunity for us.
I think that's a really important comment, especially for founders where this is their first foray into equity investment, because most founders don't even know their exit strategy. They don't even know what they're building, right? They've started something that they love and they're like, okay, well, there's some traction and let's just keep going with it. And that's probably such a valuable gift, regardless of them being able to access the funding or not, to actually be asked the question, what's your exit? How do we get out? What are you building? Right. And really kind of holding them accountable to figuring out the answers there. Well, exit is the perfect segment for us to close this part off of our episode, all about equity financing. But as we move into part 2, everybody, please come back and join us, founders, for part 2, because I want to circle back on what Laurie's talking here about EBITDA, growth, and really how do we now get an equity financier out of the business? What are they looking for, and how do we make sure they're happy as we build our business as well? All right, thanks, Laurie, for part 1 here. So appreciate you being here. We'll see you back in here for part 2. We'll see you in a bit. Bye for now.